If you buy the wrong kind of life insurance, it could cost your family over $90,000. And almost nobody tells you why, because the people selling it earn the most when you choose wrong. Today, we're settling the term versus whole life debate with nothing but math. No opinions, no sales pitch. By the end, you'll know exactly which one fits your life and how to avoid the trap most buyers fall into. This is Policywise, insurance explained honestly. Let's define both fast. Term life insurance is simple. You pay a fixed premium for a set period, say 20 or 30 years. If you die during that term, your family gets the payout. If you outlive it, the coverage ends. That's it. Pure protection. Whole life is different. It never expires, and part of your premium goes into a cash value account that grows over time. Sounds better, right? Lifetime coverage and savings. This is where the story gets expensive. Here's the part agents rush past. For the same coverage, whole life can cost 5 to 15 times more than term. A healthy 35-year-old might pay around $30 a month for a $500,000 20-year term policy. The same coverage in whole life? Often $300 to $500 a month. Same death benefit, roughly 10 times the cost. So what is that extra money buying you? This is the strategy that exposes the whole thing. It's called buy term and invest the difference. The idea, buy cheap term insurance, then take the hundreds you save each month and invest it yourself. Let's run it. Say whole life costs you $300 a month and term costs you $30. That's $270 a month, about $3,200 a year you could invest instead. Over 30 years, at a historical market average, that difference can grow into a far larger sum than most whole life cash value, which is dragged down by fees and commissions in the early years. And here's the detail buried in the fine print. In the first 2 to 3 years of a whole life policy, the cash value is often close to zero because your early premiums largely pay the agent's commission. Cancel early, and you can walk away with almost nothing. Now, I'm not here to tell you whole life is a scam. That would be dishonest. There are real situations where it fits. 1. Estate planning for high net worth families who have maxed out other tax advantage accounts. 2. Lifelong dependents, like a child with special needs who will always need support. 3. People who genuinely will not invest the difference and want forced, guaranteed savings. For the most everyday families, though, term wins on the math, decisively. So here's your honest decision filter. Ask 3 questions. 1. Do you only need coverage while you have dependents or a mortgage? If yes, lean term. 2. Have you already maxed out your retirement accounts and need another tax shelter? If yes, whole life earns a look. 3. Will you actually invest the savings? Be honest with yourself. For the vast majority watching this, the answer is term and investing the difference. Quick recap. Term is cheap, simple protection. Whole life costs far more and bundles in slow-growing savings. And buy term, invest the difference usually beats it for everyday families, but whole life has a few legitimate uses. The next question is how much coverage you actually need. Most people get this wrong in the opposite direction. I break down the exact formula in the next video. If this saved you from an expensive mistake, subscribe. We break down one insurance decision honestly every week. This is Policywise. And remember, this is general education, not financial advice. Talk to a licensed professional before you buy.